I'm investing in 5 ETFs that give me exposure to the US, international markets, and high dividend paying Aussie companies. In this video, I'm going to be breaking down all of them, exactly which ETFs I hold, why I chose them, how much they cost, and also approximately what kind of growth and income I expect to see from each. So let's get into it. Before I jump into all my ETFs, let's just cover my philosophy around investing. My goal is to build long-term wealth and not to chase quick wins on the market. I focus on ETFs because they're diversified, they're low cost, and they're really easy to manage. My wife and I, we are both emergency nurses, so our income can kind of fluctuate fortnight to fortnight, depending on what shifts and what penalty rates we can take advantage of. And with all that uncertainty in our life, that's why I want our investing to be simple, reliable, and safe. Something that I can keep contributing to even in our busy months. The way I structure our portfolio is a bit of a mix of both growth and income. My growth ETFs will help me build my wealth over time, whereas my dividend ETFs will give me some consistent cash flow in the background while also being able to take advantage of some franking credits, which is a bit of a tax loophole here in Australia. So let's kick it off with the first ETF, and it's really the bread and butter of my portfolio and kind of the grandfather of all ETFs, and that is VOO, which is an ETF that tracks the S&P 500. This is one of Vanguard's ETFs, and it tracks the top 500 companies in the US and is honestly the backbone of my portfolio. The management fee on this one is tiny. It's about as cheap as it can get. So the management fee comes out to 0.03%. And the dividend yield is roughly 1.15%-ish. And historically, as I'm sure a lot of you are aware, the S&P 500 has returned around 10% per year over the long term. Of course, some years are lower, some years are higher. But if you take an average, it's about 10%. I like VOO because it gives me exposure to some of those huge American companies, some of the most innovative and resilient companies in the world. All the big names you can think of: Apple, Microsoft, Amazon, Tesla, and that's all just in one simple investment, all in one basket. So I don't need to go around and split up my money between multiple companies. I can just put some money into this ETF and it'll be done for me automatically in the background. VOO over the last 12 months has seen a 13.35% gain, and it's currently trading at $608.75, and that's in US dollars. Just like what I said before, the top holdings for this ETF are currently Nvidia, Microsoft, Apple, Amazon, Meta platforms, Alphabet is in there, which is your Google. So massive companies that we've all heard of. You're putting a little bit of money into each of those stocks. So it's a very good way to expose yourself with a simple investment to basically the whole US economy. Moving on to ETF number 2, and that is QQQM. And this is my favorite ETF at the moment. I just find it very interesting. It's very similar to VOO, except it's more streamlined and focused. QQQM tracks the NASDAQ 100, which I'm sure a lot of you have heard of already. And this ETF can be described as a basket that focuses on the biggest non-financial companies. And it's mainly comprised of tech companies, again, like Nvidia, Microsoft, Apple, Amazon, Tesla, Meta. So the reason why I'm holding this ETF is because, yes, it exposes me to the same companies as VOO, but it's more compact and streamlined. It would be classed possibly as a more risky ETF than VOO would be. However, that risk is very low because they're still massive companies, resilient companies. If all of these companies were to go under all at the same time, there's something a lot bigger happening in the world than you just losing your money. So the reason why I invest in this ETF is because, yes, it might be classed as slightly more risky compared to VOO, but it's more compact into 100 companies that will hopefully show me a lot more growth and quicker growth over time. As I'm very early on in my investing journey, I'm very happy with my money being in this ETF. The fee for this ETF is around 0.15%, so it is a little bit more expensive than your VOO would be. And because it's focused, yes, it is a little bit more volatile, but it has that higher growth potential that I'm seeking. Dividend yield for this company is around 0.5.5%. Pretty low, but that's not really why I own it. I'm investing in QQQM for its innovation exposure. It's like a growth engine for my portfolio. I know it will fluctuate day to day, but I'm investing this money for decades. So it's not really something that I would worry about, those fluctuations. QQQM over the last 12 months has seen a 20.25% increase. And it's currently trading at $246.21, again in USD. Now, the third ETF I have to round out this Wall Street side is VEU. And this is Vanguard's All-World ETF that excludes US markets. It gives me exposure to markets in Europe and Asia and all those emerging economies. The management fee for this ETF is 0.08%, and the dividend yield is around 2.75 to 2.8%. Again, not why I'm holding it. It's also not the highest performer out of these three ETFs, but that's not why I'm holding it either. The reason why I'm holding it is because it's important for diversification. I don't want to be 100% reliant on the US market and economy. So VEU helps me spread my risk globally and lets me benefit from things that are happening in other countries as well. VEU to date is tracking at 14.09% over the last 12 months. So technically it's actually performed better than VOO over the last year. And it's currently trading at $71.27, again in USD. Now that rounds out my Wall Street side. So as you can see with those three ETFs, they're all highly focused on growth and a long-term mindset. I'm not looking for big dividend payouts. I'm looking for innovative companies that are going to make me money over the next 30 to 40 years. And this portion of my portfolio does hold the majority of my invested money, just to start those compounding gains early. So now onto my Aussie ETFs. And we're starting here with VHY. This one invests in high dividend Australian companies, big banks, Telstra, BHP. The management fee for this one is the highest yet at 0.25%. And the dividend yield over the last 12 months has actually been around 8.4%. And as you can see here, it's about 90% franked. So what franking means is when Aussie companies make profit, they pay tax, usually around 30%. Now, when these companies pay you a dividend, it's giving you money that's already been taxed. So the ATO has already taken their cut. To make things fair, the government doesn't want the money to be taxed again. So thank you, Australian government. So they give you a little receipt called a franking credit. Basically proof that the company has already paid tax on your behalf. At the time, you can use those franking credits to reduce the tax that you owe, or if you don't owe a lot of tax, you might even get a little bit of it back as a refund, which is pretty cool. So in simple terms, franking credits equals extra tax benefits for Aussie dividends. That makes Aussie dividend ETFs even more rewarding, especially for those long-term investors. And that's why I have centered this side of my portfolio here in Australia completely around dividends. And it's also why I like this ETF VHY, because it's going to give me a reliable income. It feels good knowing that I'm also investing in Australian companies. Some of those companies I use every day, so that's pretty cool. Finally, for VHY, we have seen a 4.4% increase over the last 12 months. Again, you're not going to see as much growth as those other ones because it's mainly a dividend paying ETF. And it's currently trading at $78.24. Now we're in Australian, so that's Australian dollars. And this brings me to my final ETF, which is IHD, and this is another Australian dividend paying ETF. It's very, very similar to VHY, but it holds a slightly different mix of companies, which gives me extra diversification within my income holdings. The fee for this one is about 0.23%. And the dividend yield for the last 12 months has been around 4.3%. And as you can see as well, majority of the income you'll be getting is eligible for franking. And we've seen a little bit more growth on this one than the last one. Over the last 12 months, we've seen a 12.68% increase. And it's currently trading at $16.26, again in Australian dollars. It's not built for massive growth, although the growth has been okay. It's going to provide steady income and help smooth out my cash flow. So right now, my portfolio is roughly split 60% into my growth ETFs, VOO, QQQM, and VEU, and 40% into my income ETFs, VHY and IHD. It doesn't look exactly like this at the moment because it's still very much in its early days, but I'm going to be filtering money into these ETFs to try and reflect those percentages as close as I can get it. And the goal for my portfolio is to build wealth through growth while reinvesting dividends to compound faster. Later down the track, I'm hoping to lean more into the income side to support our financial independence. But for now, compounding gains is the game, and it's the game that I'm playing. Now, of course, ETFs aren't risk-free. The market goes up and down, but I'm playing the long game here. I invest regularly, I stay diversified, and I'm not trying to predict short-term movements. I'm not a financial advisor, so please don't take any of this as financial advice. I'm just a registered nurse sharing my investing journey and decisions, hoping to build financial freedom one day. If you found this helpful and you want to see exactly how much money I've got in each of these ETFs today, check out my monthly net worth updates where I show you exactly how these investments are performing in real time. If you got value from this video, hit like and subscribe, and leave a comment down the bottom telling me what ETFs you guys are investing in and what's got you guys excited. I'll see you guys in the next one, and as always, good luck with your wealth building journey.
Hey guys, if you enjoyed that video, you should click here. No, because YouTube thinks you'll like this video. You should click it. No, but seriously. Come on, why haven't you clicked it yet?